So, Ilana, we know that there were slight improvements overall in aggregate, let's say, for the whole industry, but where were the strategies where we saw, outsized gains or severe losses?
I have to tell you, Vonnie, this was an unbelievable year for the most part across the board. This was an alpha year for the industry, and I think it was a great defense of the asset class. We saw phenomenal gains with the multi-managers. Citadel once again hit it out of the park. They're up 20%. Millennium in 0.72 in the teens. Bally, O'Connor, Exodus Point, multi-managers that historically have had a little more volatile or muted performance, up 27, 25, 11%. Long-short equity funds, which historically have had a difficult time justifying their fee structure because they weren't producing enough alpha. Even those that are very correlated to the market, producing returns upwards of 50, 70, even 90%. Macro did great this year. Again, we're seeing inflows to macro for the first time since Q1 18. And I would argue even areas that have had more difficulty, like quant, has had winners. We saw an article today on World Quant up 20% and structured credit as well. It was all about being nimble and being able to sort of quickly reposition and take advantage of market opportunities, whether that was hedging real estate exposure or pivoting from work from home to recovery stocks when the COVID vaccine news hit. You just needed to be liquid and hedged and tactical with regard to smart trade selection and sizing. But it was, Vonnie, it was a no excuses year.
Right, although there were some quant funds that had terrible years and really suffered from it. Ilana, you said last time you were on that the pandemic was going to be the great equalizer for the hedge fund industry. Did it pan out that way then?
Yes, I absolutely believe that. You look at funds like Soma up 30%, Alkeon up 45%, Whale Rock up 70%. That's on long short equities. Within credit, you had you had funds that didn't do well, and I'm not even talking about like deep distressed funds that were laden with illiquid positions that were legacy and difficult to hedge. But if you look at funds like CQS's flagship fund, down 41% year to date, or funds like King Street and Anchorage, if you look at the cumulative performance for those funds for the last 3 years, it's just not there. And so as a result, we've seen AUM really drop dramatically. King Street started 2020 with 20 billion. They're now 16.5 billion. Just to give you some context, Anchorage's fund flagship was 14.6 billion in 2017. It's now 8.4. CQS is predominantly long only. And yet again, we've seen other credit funds like Saba, Apollo's liquid credit fund, Diameter do very well. Citadel's credit efforts done phenomenally well. It's all about, yes, again, being able to take advantage of opportunities.
I mean, in defense,
and not being laden down with the liquid assets.
And in defense of some of those, I'm sure some would say that the time hasn't yet come for them to show performance, right? That the cycle's still playing out, and perhaps next year there'll be better metrics to judge them on. But Ilana, what do these allocation pulls by LPs or what have you? What does it mean for the industry overall?
Well, I think there has been a lot of press about the biggest allocators to hedge funds trimming their allocations down by, I think it was 16%, and the industry still having net outflows. But I think we need to look at it in context, because the reality is net outflows are half of what they were last year. Last year was 100 billion. And this year is 48 billion. And LPs are not, I don't view this, Vonnie, as a pullback from hedge funds by any stretch. I view it as LPs being smarter about where they're allocating to. And we've seen that with tremendous spikes for funds that have done well. I mentioned, Soma earlier. You may not have heard of it because it was a fund that was 58 million in 2016, and it's now 3.5 billion. Whale Rock was 6 billion in June. It's now 11 billion. So, the money it's like water finding its level. And also there are funds that are struggling and we've seen fee compression. And then there are other funds that are charging 3.30 or 2.40 like Element, or 3.30 like DE Shaw, or the best multi-managers can just charge whatever they want. So again, there's efficiency.
What about headcount in the industry overall, Ilana? Is it on the decline, or is it just moving around? And also address compensation for us.
Well, again, it's about who's growing. The multi-managers sort of have an infinite appetite for talent, so they're always growing. Single manager funds don't, they don't have as much capacity, so it's not even so much a function of are they doing well or not well. It's just, it is to some extent, are they doing well, but they just can't continue to add headcount because there's capacity issues, whereas the multi-managers are basically it's a combination, a constellation of hedge funds with a layer of risk management on top. So that's what we're seeing the most growth. Compensation. This will be a really interesting year because so many funds have done so well. And ironically, I think that's what's tough for founders to figure out. How do you pay someone at a fund that's up 50% when they've been one of the key drivers of that performance? How much, because that's a big number that they're due this year. The way the industry works for single manager funds is more senior people have points in the fund, and then there's a bucket, which is kind of like a jump ball. But if you're responsible, if it's a $10 billion fund that's up 50%, and you're responsible for a quarter of that performance, how are you going to get paid? And will it be enough to keep you there and not make you feel like you should really go out on your own or go to a top multi-manager, which can effectively, let you run your own thing?
Fascinating. Ilana, what's the obsession with SPACs this year? It feels like a lot of hedge funds have raised SPACs.
Yes. Everybody's talking about SPACs. I even had lunch with my mother the other day, and she called it. She was asking me about SPACs, although she called it SPECs. I think it's I don't know. I'm dubious, Vonnie. I feel like everyone is. There's been too much issuance, and I'm not sure there are enough good private companies to justify the issuance. And of course, as you know, there's a 2-year fuse to make these deals happen. So we'll see. I think it's overheated.